Buenos nachos everyone, and in this video I will be talking about AMD / Power of 3. These two concepts essentially go hand in hand. So without wasting more time, let's begin. Alright everyone, so before moving on, I think you guys should know this. You should definitely, actually it's mandatory that you watch all my other videos down from the first episode all the way up till now when it comes to the ICT simplified series stuff, because if you don't, you're going to have a very hard time understanding the concept, because every single video I have made and planned for it to build on top of each other. So like I said, if you don't watch it, it's going to be extremely hard for you to follow along. And lastly, if you don't want to download the presentation, you just want to view it, there's also a link for that down below in the description. So without wasting more time, let's begin. Alright, so first we have our introduction to AMD / Power of 3. Let's begin. So welcome and overview. Introduction to Power of 3. The Power of 3, a concept by ICT or Inner Circle Trader, breaks down financial market movements into three key phases: accumulation, manipulation, and distribution. These phases show how candles or bars form on price charts, and they apply to all time frames, especially the daily and weekly trading ranges. Here, the opening price marks the start of the period. Now, real quick side note, you can actually use accumulation, manipulation, distribution without necessarily the opening price of whatever asset it is that you're looking at. Accumulation, manipulation really does show up in any time frame at any point. As long as you can spot accumulation, manipulation, and distribution, you don't need to be in a specific time period or time range. Okay, so for trading within a day, focusing on the weekly and daily Power of 3 is usually enough. So if you're like a scalper, usually just using the weekly and daily Power of 3 is enough, but obviously we're going to get into that a little more. However, it's also helpful to consider the monthly candlestick, as significant points on higher time frames can improve your chances of successful trades. Now, you don't really need it. You can if you want to, but you don't absolutely need it. Okay? Do keep in mind that the Power of 3 is identified differently on each time frame. For example, the criteria you would use on the daily candle to find the accumulation phases on the lower time frame is different from how you would find it for the weekly candle, and the higher the time frame, the more it changes. So when we're talking about the Power of 3, we're talking about a little bit extra outside of AMD or accumulation, manipulation, and distribution, because the Power of 3 is kind of like a little strategy in a sense on its own, and then AMD is kind of a little bit separate. But Power of 3 basically comes from AMD. It's just that with the Power of 3, you're adding a few more steps to use it to frame your bias or your trade plan. Alright, Chapter 2, Understanding the Power of 3. What is the Power of 3? The Power of 3 is a pivotal concept in trading that comprises three distinct phases the market typically undergoes before experiencing a significant price movement. This concept, popularized by ICT. Now, the definition. The Power of 3 refers to the uniquely structured sequence of market activities. In other words, there's a specific sequence that ICT claims the algorithm does. First being accumulation, manipulation, and lastly distribution. These stages reflect the various actions taken by significant market players, influencing the market's overall direction and momentum. Now, you will see a lot of this stuff being repeated throughout the presentation, but I do it on purpose to ingrain it in your head. So hopefully it'll be easier for you to understand and use after the end of this video. So, overview of accumulation, manipulation, and distribution. Number 1, accumulation. Description. This initial phase involves market participants building up their positions in anticipation of a future price increase or decrease. Characteristics. Price often consolidate and trade within a range. Number 2, represents a period of preparation for the next market move. Now the goal, identify where traders are quietly accumulating positions before the price takes off. Now number 2, manipulation. The description. The second phase deals with market manipulation, wherein large traders use various strategies to steer the market in their favor. Techniques, generating false moves or signaling incorrect trends. For example, the Judas swing. That's just one of the many models there are out there according to ICT. Inducing less informed traders to make unfavorable trading decisions. That's number 2. Now goal, recognize and avoid the traps set by institutional traders looking to capitalize on smaller traders' movements. Now number 3, distribution. The description, the final phase where those who accumulated positions in the first phase begin distributing or selling off their holdings. Characteristics, the market might show signs of a peak or entering a new consolidation phase. Number 2, price may reverse direction as holdings are offloaded or as price ends up being bought or sold. Now the goal, identify when it's time for large market participants to release their positions, potentially signaling a market reversal or significant move. It could go either up or down, it just depends on the overall bias that you're looking at. But again, I'll explain it a little more deeply in a sec. Chapter 3, Phase 1, Accumulation. Now we get into the real good stuff here. Explanation of accumulation phase. So, accumulation, again, is when smart money, like institutional traders, start building up positions without causing significant changes in the price. Think of it as quietly buying up stocks or whatever it is that you're looking at. It works on anything without drawing too much attention. This phase can be sneaky because while smart money is buying or selling, the price mostly stays in a stable range, making it less obvious to the average trader. So there's plenty of ways that price can accumulate. It might not look the same, but I promise you, the more chart time you get, the easier it is to spot. Characteristics of accumulation. Consolidation. Price often moves sideways within a narrow range and or it can even be a wide range. So you can have your thin consolidation, you can have a very wide consolidation. But the point is, if you spot price consolidating, that is the first phase. Again, showing little upward or downward movement. This is known as consolidation. Low volatility. There's typically low trading volume and volatility, making the market appear quiet and uneventful. Now, low volatility is pretty common in this phase, but sometimes there's high volatility consolidation. So you can have those big movements up and down, but if you notice price stays between a support and resistance level, that is another sign of price accumulating. It's just that sometimes it makes it seem like price is going somewhere, but if you were to zoom out a little bit more, maybe at the higher time frame upward, you'll notice that it's actually price just consolidating. So the next one is support/resistance levels. The market tends to find strong support and resistance levels where price stops failing or rising and starts hovering. Examples of consolidation patterns. Flat price action. Price stays relatively stable, moving sideways without showing any strong trend, kind of like Asia session. Next, you have the ascending triangle. Consists of higher lows while resistance remains horizontal, indicating gentle buying pressure. Next, you have descending triangle. Shows lower highs while the support level remains flat, indicating gentle selling pressure. So I got a little example here for you. So here you have that ascending triangle and you have that horizontal line / resistance, right? You have 1, 2, 3, 4, 5, kind of like Elliott wave. So you might see me referring Elliott wave a little bit here and there. I'm sorry, I just love Elliott wave. And here's another version of that triangle pattern. And here you actually have that descending triangle, but this time you have the horizontal line or your resistance. Price accumulates and then finally breaks down. Same here, price accumulates, but this time it's contracting a little bit and then finally breaks out and continues going down. Some people make some pretty good breakout strategies with this. It's up to you and how you decide to trade. I will be coming up with some strategies using accumulation, manipulation, distribution, but I want to get through with all my series videos, or at least the important ones, so that way I can refer you guys to them when I do make the strategies. So let's move on. Okay, identifying accumulation in market charts. Sideways movement. Look for price consolidation where the market isn't going too far up or down. This is often seen on charts where the highs and lows form a sort of rectangle. Number 2, volume increases. During accumulation, volume might increase subtly, indicating the entities are starting to build their positions. And number 3, reverse candlestick patterns. Patterns like a doji or hammer indicate potential accumulation after a downtrend or uptrend. So I got an example here for you guys. Here, as you can see, I have a doji indicator marking up the accumulation. So this is actually a great example of what I mean, that sometimes price can accumulate pretty strongly in a volatile way. And so as you can see, price is accumulating, but sometimes can have those big sharp moves down. You can look at this wick and see that price had went down pretty strong and then rejected. And then price finally came up here, rejected, came down here, rejected, came up here, and then a strong rejection, right? Just a quick example of accumulation. Now we have bullish and bearish scenarios. Bullish scenario. If the market is in an uptrend, the accumulation phase can be a signal that the market is just taking a breather before continuing to move upwards. In a bearish scenario, conversely, if the market's been declining, the accumulation phase might be a sign that the market is preparing to reverse and move higher. So I want you guys to look at this real quick. This is what's known as the open, low, high, close. Why? Because if in a bullish candle, you're opening low or basically at the bottom, and then you're closing high, which is this area right here, right? The body, this high point of the body. And then here you have open, high, low, close. Why? Because you're opening at a high area or a high price point, and then eventually you close at the bottom. You close in a low point. Now here, generally the open is looked as the accumulation, and then the bottom wick here of a bullish candle is looked as the manipulation, which, by the way, SMT can also be used here. So if you're an SMT trader, you can definitely pair up AMD or PO3 with it. And then finally, you have the distribution, which is essentially this whole body right here. And same thing here, you have accumulation at the open here in the top. Price manipulates, takes out some liquidity, which would be this wick, and then finally distributes down, which would be this body candle, or even down here. Same thing for the bullish. Chapter 4, Phase 2, Manipulation. Understanding manipulation. Manipulation in trading refers to actions taken by powerful traders, often called smart money, to influence the market price in their favor. This can involve creating false market moves to trap other traders, known as retail traders, on the wrong side of the trade. Techniques used in manipulation: false price moves. Smart money creates deceptive price movements to mislead retail traders. A common technique is the Judas swing. This is where a sharp but temporary price movement occurs in one direction, only to reverse quickly afterward. The next one would be liquidity sweeps. So smart money targets liquidity areas where many stop loss orders are placed. By sweeping through these areas, they can fuel the Judas swing before reversing the market. So like I said, if you haven't seen my previous videos, I actually talk about the Judas swing, so you got to look at it if you're interested in knowing what the Judas swing is and how it works. Next is recognizing false moves and Judas swings. So a Judas swing happens during specific times and events. For example, 9:30 a.m. New York session, short-term liquidity levels get taken out, followed by a reversal. Next will be the 10 a.m. news release. If there's news, the Judas swing might occur between 10 and 10:10 a.m., targeting opposite liquidity levels. Now this is New York time, by the way. These sudden movements can indicate the start of the manipulation phase. So I actually got an example with the 2 a.m. news release here. So there was some news injected here at 10, and as you can see, you have some accumulation. Then the manipulation part. The manipulation actually occurred slightly before news, or it could have been in anticipation of it. But once news came out, price decided to move or reverse downward. And as you can see, price went down and took out the liquidity on the opposite side. Pretty neat, huh? Impact of manipulation on market sentiment. Manipulation affects market sentiment by 1. Creating confusion. Retail traders may get trapped, leading to confusion and erratic market behavior. Number 2. Influencing decisions. False moves can cause retail traders to make impulsive decisions based on temporary price movements rather than solid analysis. You need to have your psychology in check. Why? Because impulsiveness in this game is going to get you hurt. Physically, emotionally, spiritually, any way that you can imagine getting hurt, you'll get hurt. Okay? So, bullish scenario. In a bullish scenario, the manipulation phase might involve pushing the price down to a certain level before smart money initiates a buying spree, reversing the price upwards. In a bear scenario, it could involve driving the price up falsely to attract buyers, then swiftly selling to drive the price down. So again, I refer back to this image here. As you can see here, you have the manipulation, right? Taking out all the liquidity here, and all of you impulsive traders would think, oh, price is going up, let me start buying. You may or may not get lucky and get out on time, but if you were one of those unlucky people, you got wrecked by the distribution. Now, I will say this, it isn't always easy to predict these movements. Sometimes the best thing to do is to just wait until price finishes manipulating and then entering on the distribution phase, because it's very, very hard to capture only the manipulation part and to predict what order block or what price level the manipulation is going in, because quite frankly, it could happen at any moment. It could be the smallest thing that'll set it off to reverse. So whatever you do, just wait for the manipulation phase to end and keep an eye out for the distribution. Again, it's not always easy to spot, but those are the best ways that I at least would recommend for you to mitigate any losses. Let's move on. All right, so practical example. So bullish manipulation example. Price consolidates around an area, which would be accumulation. Smart money triggers a false downward move. Again, the manipulation phase known as Judas swing, and the price reverses sharply upwards as smart money capitalizes on the lower price to buy, which would be the distribution phase. And then bearish manipulation example. Price consolidates. Smart money pushes the price up temporarily, creating a false sense of a continuing rise. The price then drops significantly as smart money sells off their positions. Now I have an example here again, and I've actually decided to use examples of other traders so that way you don't think that I'm just blindly using my own stuff. So shout out to the fair value god for this one. Here, as you can see, we have that accumulation, then the manipulation, and again, price can accumulate even after tearing through the first one. Finally, price breaks out and starts distributing down. And here again, shout out to Elijah Henoch 7. These will all be hyperlinked, by the way, so you can all check out these people. Here again, you have the accumulation, the manipulation, and then price finally distributes. Now, a few good ways to try to see if manipulation finally ended is you get that break of structure to the opposite side. And if you see it reacting to a point of interest, like an order block, or in this case, a fair value gap, you compare those two things up and you'll get a pretty solid confirmation, right? A good way or place to enter would be maybe at the break of this candle, of this upside right here. You should be good to enter for a buy, put the stop loss under here. Right? That's just a quick example. But yeah, you can pair those things up and hopefully you can sort of anticipate or tell yourself, okay, it looks like the manipulation finally started and I think the manipulation finally ended. It's going back up to the other side. All right, just one example. Lastly, manipulation in trading is like a trick that big players use to mislead smaller traders. They make the price move in a fake direction to trap others. This trick, called the Judas swing, can happen at times like 9:30 a.m. or when news comes out at 10 a.m. Imagine you want to buy something cheap First, you pretend the price is dropping to scare people into selling. This is manipulation. Then you quickly buy it all up when the price is low and sell it when the price goes up. The same happens when the big players want to sell something at a high price. So whether the price is going up or down, smart money uses these tricks to make profits while confusing the rest of us. This can make the market seem unpredictable and lead to the wrong decisions if we're not careful. Chapter 5. Phase 3 Distribution. The distribution phase. Distribution is the final phase in the power of 3 concept. After accumulation and manipulation, the distribution phase occurs when market participants who accumulated positions in the first phase start to sell or distribute their holdings. This phase is marked by a shift in the market where the profits are realized by those in the know, often after having misled retail traders during the manipulation phase. Characteristics and signs of distribution. The distribution phase has distinct characters and signs. Now, one of them is unwinding of positions. Traders or institutions begin to sell off their accrued assets to retail traders. Now, really, distribution doesn't mean specifically only selling. It could also mean buying, right? They start buying their positions back. Price spikes and jerks. Yes, that sounds weird, I know. Unlike the smooth movements in other phases, price action can be unpredictable. Now, reason why I say that is because sometimes price can shoot up rapidly, or price may seem like it's shooting up rapidly or shooting down. Price can make a quick pullback or accumulate, or anything can happen, and then it'll continue going up or continue going down. So number 3, volume increase. There's typically a higher trading volume as positions are distributed. Now, recognizing distribution in market charts. Candle patterns. Look for signs like larger candles, both up and down, indicating increased participation. So sometimes you can see accumulation of candles, like a small accumulation, like 3 or 4 candles not breaking past their support or resistance. Or you can see an engulfing candle or like a 3-line strike, which are like my personal favorite candlestick patterns, stuff like that. Support and resistance levels. Pay attention to breaks and retests, which can signal the unwinding process. So if you're in a bullish distribution phase, you want to see a breakout from a resistance, and if you're in a bearish distribution, you want to see a breakout from the support. Volatility. Increased price swings are common as distribution kicks in. Now, bullish scenario. In a bullish market, distribution happens after prices have temporarily dropped, which would be the temporary manipulation phase, and institutions start buying their positions back, expecting prices to rise further. Now, for a bearish scenario, the opposite occurs in a bearish market. After a temporary uprise, smart money starts selling their positions taken earlier. Simplified explanation. So, phase 3 distribution. What happens? Big traders begin to sell off their assets if the market went up during manipulation, or buy them back if it went down during the manipulation phase, passing them to new investors. Look for big trades. Larger trading actions mean stuff is being sold/bought in bulk. Price movements. More sudden changes in price can be noticed. Next, trading volume. More people are trading, indicating the phase is active. So if you see something like this, it won't always look like this, but something like this, that is more than likely distribution. So if you're in a higher time frame and you see this kind of price action, you can drop down on a lower time frame and scalp that movement, right? Scalp the distribution phase. All right, chapter 6, application in trading. Daily and weekly trading ranges. The power of 3 is a fascinating concept in trading that breaks the market down into 3 key phases: accumulation, manipulation, and distribution. Let's explore how you can apply this concept to both daily and weekly trading ranges, with examples for both bullish and bearish scenarios. So, understanding power of 3, you can actually read all this if you want. I'm not going to waste a lot of time trying to repeat everything that we just went over, but you can pause the video and take a look at it. So, application in weekly trading ranges. So for bullish bias on the weekly, the accumulation phase, at the start of the week, expect a move below and above the opening price, which would be Sunday 5 p.m. New York time, as part of the accumulation phase. Now, something you should note is that in the accumulation phase, on the start of the week, sometimes price can move slightly above, or it'll just move below and accumulate under it. Like, anything can happen. Like, you can come up with so many scenarios, right? Price rising above and accumulating above the opening, or like I said, coming down a little bit and accumulating under the opening, or it'll come up and then come down, come up and then come down, or the accumulation can form before, after. I mean, it can happen at any moment during the Sunday opening. Okay, now manipulation phase. The weekly low is often formed between Monday and Wednesday, typically on Tuesday or Wednesday. It really can form anywhere between Monday and Wednesday. This fake out move, known as the Judas swing, tricks traders into thinking prices are going lower. Now, this is just, take it as a recommendation, okay, as a tip really, because the low can quite frankly form at any moment. In an ideal situation, the low would form on a Tuesday, right? So we would have accumulation on Monday, and then the low would be like on a Tuesday, and so on and so forth. But like I said, anything can happen, and I'll go over an example of what that would look like. Now, distribution phase, look for prices to return above the opening level, signaling the potential for a reversal and sending prices higher. Now, bearish bias for the weekly. Accumulation phase, at the start of the week, expect a move above and below the opening price for the initial accumulation. We already went over this. Manipulation phase, the weekly high usually forms between Monday and Wednesday, with Tuesday or Wednesday being common. Distribution phase, if price returns below the opening level after this manipulation, there is a potential for a bearish reversal. So I got two examples I need to go over with you guys. Ideally, you would have Monday as the accumulation, and you can have manipulation on Tuesday or Wednesday, or the manipulation can form between Tuesday and Wednesday. So these 2 days could just be manipulation days. And then Thursday you have distribution, and then Friday price can come back down into the weekly range again. So after price has distributed on Thursday, price could form a change of character, right? And it could come back down into anywhere in this area, or it could keep going up, right? Anything can happen. Now note, the weekly low forms between Sunday and Wednesday. Odds increase between Tuesday and Wednesday. Now for the bearish accumulation, Monday you can see it starts accumulating. Tuesday you can see manipulation again, or Wednesday, like I said, it can form on both days. Distribution Thursday, and price can come back down into the weekly range again. Now the next example that I want to show you is this one real quick. So here is the opening price, right? Sunday, but I got it marked here for Monday. So this is Monday, Tuesday, Wednesday, Thursday, and Friday. Friday's here, Thursday, Wednesday, Tuesday, Monday, or you can also count Sunday as being part of it, or Sunday back here. Now I have a bearish example here using the 1 hour time frame. As you can see, opening price is here. Price moves above the opening price, but still consolidating. And then on Tuesday, you can see price is actually swept up by these candles. All right, so the consolidation, all the stop losses get swept. So that would be the manipulation here. And then finally, price starts distributing down on Wednesday, and with Thursday giving the final sweep of liquidity, as you can see right here, with price repricing itself, going back up, back into the range, or back over the opening price. And the TGIF model can also be found here. Now if you want me to explain the TGIF model, I would have to see significant requests in the comments, because that is a whole nother thing, right? And if I'm going to do something, I want to do it right. So I don't want to just give you a quick overview of what the TGIF model is without giving you a proper understanding of it. I'd rather make a separate video on it. So yeah, study this, open up a chart, see if you can replicate it. And like I said, not all the examples are going to look this clean. Obviously, all the examples I give you and show you are cherry picked, but that's just to convey the message. All right, now let's talk about the application in daily trading ranges. So daily power of 3. Use the opening level to pinpoint profitable zones for entering both long and short positions. Manipulation, similar to weekly, wait for the Judas swing to finish capturing liquidity. Applying daily power of 3 helps set expectations for daily highs/lows and helps in timing entries. So I want to take a look at this first example here. So here you see you have two different types of openings, right? You have the London session midnight opening price, 12 a.m. New York time, and New York session opening price, 8:30 a.m. New York time. So I have a bullish example here for you. So you have your daily drawn liquidity or a higher time frame array or on the same time frame, and price starts accumulating, whether it's going up, a little bit down, maybe it starts making like an opening triangle, and you'll see price takes out liquidity here, comes down, takes some liquidity, and then finally we have the opening price. Price slightly trades above the opening, comes down. Here you can find Judas swing, which let's say for this example happens to form around 10 a.m. Just as an example, not saying it always forms, but let's just say the Judas swing forms around 10 a.m. and then finally you have your distribution reversing back up. So if you want to trade the Judas swing on its own, I could try making a video on it, but I'm gonna be completely honest. For the Judas swing, it has to be pretty technical and you have to watch multiple pairs to make it worth your time. But I see as a Judas swing as more of a beginner ICT strategy, just because it's very mechanical. If you're trading it the way I would show it to you, other people would obviously trade it the same way. So the problem would also be that you might not get setups every day or the setups that you want. And trading multiple pairs will affect the win rate and the strategy itself, because not all pairs move exactly the same. Sometimes very similar, but not exactly. So, it's up to you. Now here again, I have the bearish example, but we have the Judas swing. Again, happens to form around 10 a.m. And first we start accumulating, right? So you have opening price. Maybe it'll look like this. Sweet consolidation. Price moves up, takes out opening price, then moves out, takes out liquidity here. Now after price takes out this set of liquidity here, you can see it comes up, takes out whatever is above here, and then it can possibly accumulate, or just real quick goes up, creates a pullback, sweeps up this higher high, and then reverses back down, distributing to the drawn liquidity or your higher time frame array, or whatever array it is that you find. Could be an order block or could be a fair value gap. All right, like I said, accumulation can form anywhere between before and after or during the opening price. So here you can see price was already accumulating before the midnight open. What does price do? Consolidate a little bit under it, comes up, then the candle comes down, sweeps this liquidity, then starts trading back up, consolidates up here, and then finally it goes back down again. We see a pullback, comes down a little bit more, sweeps up this bit of liquidity left, and then finally starts distributing back up, does a little bit more of a pullback, and then finishes its last bit of distribution to the upside. So this is what I mean by price can be a little unpredictable when it comes to when it accumulates, how it looks when it's manipulating, and how it looks when it's distributing. All right, let's talk about applying power of 3 in different time frames. So the how-to: weekly and daily time frames. Higher time frames like weekly and monthly can increase your chances of success. For scalping / intraday trading, it is sufficient to utilize weekly and daily power of 3 insights. So if you're a scalper / intraday trader, just using the weekly power of 3 or daily power of 3 is more than enough. Now guys, anything you do in trading is really discretionary, so it's up to you and how well you are at looking at price, reading price. That's why it's so important to put in your chart time, because like I said, at the end of the day, it's all discretionary, and the better you are at reading price, the more likelihood you will have having good profitable trades. Now, tips for bullish and bearish scenarios. Bullish scenario: wait for initial manipulation below the open. Enter long positions after price action confirms a new bullish trend. Look for price rising above the open and shooting higher. Bearish scenario: wait for initial manipulation above the open. Enter short positions after price confirms a bearish shift. look for price falling below the open and continuing downward. So let's look at these examples real quick. Again, you have your accumulation, manipulation, and then distribution. And if we look at the bearish example, we'll look at the opening price, right? Manipulates, goes above, trades above it. It'll take out some liquidity. Again, it will look something like this. It won't always look like this. There's different forms of accumulation and then different forms of manipulation here on this side. So keep in mind, price can also accumulate after taking out the accumulation liquidity. So it can go up here, right? Accumulate a little bit and then go down and distribute. But at the end of the day, it's all the same thing: accumulation, manipulation, and distribution. Now, practical example, we have a bullish example for the weekly. Monday, price initially drops below the opening price. Tuesday or Wednesday, price forms the weekly low, the manipulation phase. Thursday, Friday, price reverses and moves higher, forming a bullish trend. And now for the bearish example, which is basically the same thing. Monday, price initially moves above the opening price. Tuesday, Wednesday, price forms the weekly high, manipulation phase. And then Thursday and Friday, price reverses and drops lower, forming a bearish trend. All right, chapter 7, conclusion. Key takeaways. So one is accumulate knowledge, right? Grasp the essence of each market phase. Recognize that what may seem like chaos often follows the power of 3 pattern. 2, use opening price as a benchmark. So one thing you can do is mark the weekly opening price each Sunday evening and track how prices moves relative to this level. And next, you could also keep an eye on Monday to Wednesday actions for potential manipulation swings. Again, manipulation can occur at different days. Next is wait until you finally see that change in trend after the manipulation is done to actually start trading. So my recommendation again is to trade only during the distribution. All right. Next is use kill zones when trading. Not mandatory, but it is recommended. I recommend using the 15-minute time frame for scalping / intraday trading. That's just my opinion. You don't have to use the 15-minute time frame, but if you do want to make a strategy using AMD, the 15-minute is always my go-to. Now, strategies like Turtle Soup, Judas Swing, Unicorn Model, and any other ICT strategy can be paired with Power of 3, as well as any other SMC strategy. So you guys don't have to just be restricted to ICT models when it comes to AMD. You can also use any other model or any other strategy based off of SMC. You can even use supply and demand. Now, final thoughts and recommendations. One is to stay observant. Always be on the lookout for the 3 phases in action. Use the insights to refine your trading strategy and improve your accuracy. Number 2, practice discipline. Implement the power of 3 concept in a disciplined manner. Don't rush into trades without completing your analysis on the phases. Please, guys, for anyone that's listening, do not rush into a trade. Make sure you do all of your analysis correctly. A lot of problems that I've seen people do is that, let's say they wake up late or they wake up during their normal trading hours and they see that the trade that they probably would have gotten in before doing their analysis is already taken off without them. That is the worst thing that you can do, is to enter just blindly and say, okay, then I'll do my analysis. That's ridiculous. Please, guys, do your analysis first. There will always be another trading opportunity in the markets. That's the beautiful thing about trading. There's always an opportunity no matter what. Now, number 3, educate yourself continuously. Trading is ever evolving. Keep learning and stay updated with the new techniques and insights from trusted sources. After a while, guys, you'll realize that everything that is talked about, every topic, every theory, every new technique, any tip, any insight, it's all fairly the same thing. If you were to take notes on every single video that you look at, on every single mentor's course, you'll realize that it's all the same stuff, just regurgitated in a different way of being said or being presented. And at the end of the day, it's all the same stuff. Trading is not that complicated. It's just that a lot of people make it seem complicated to sell you a course and say, oh look, I've uncomplicated this topic or this certain thing. At the end of the day, ladies and gentlemen, it is literally all the same stuff, just some of it seems more fancy than other stuff. Okay, so let's move on. Lastly, ladies and gentlemen, I want to just say thank you so much for sticking to the end of this video and for watching it. Before I leave, it's always I like to give you a little wisdom here, biblical wisdom. So Proverbs 15:32 says, "Those who disregard discipline despise themselves, but the one who heeds correction gains understanding." Ladies and gentlemen, please practice discipline. And if you're being disciplined, and in this case, relative to trading, I'm trying to discipline you guys to stay consistent, to not give up, to give yourselves more chart time, and to not rush into trades. Okay? Please listen to me on this. I know what I'm talking about. All right? I pray that God blesses you, that if anyone's going through a tough time, whatever the case may be, hit me up, hit someone up in the Discord, find help. No matter who it is, I'm pretty sure someone out there is willing to lend an ear. And if I don't respond, it's not because I don't want to. It's usually because I haven't seen the message, and by the time I do see it, it's sometimes already too late. So please look for help. If there's any question you guys have regarding trading, hit me up in the Discord. And if you're going to something personal and just want to hear or have someone hear you out, try messaging me or email me, and I'll do my best to respond. Okay? Other than that, God bless you, everyone. Happy trading, and may the power of 3 be with you. Peace.